out there. Today I want us to do an introduction to credit management. I know many businesses or many people, they talk about collecting their debts or collection or debt collection. But today I want to do a brief introduction of the nature of credit management so that you can be able to understand the concept of credit management in a business or in whatever state, in whatever type of business that you are running. When we are asked what credit is all about, this involves giving goods and services to customers on credit. Or when we talk as from a perspective of a banker, we are talking about giving money, which is a product, on credit basis to customers. So we give customers the credit facility, we give them the goods, they have access to the goods and the services that we are offering and expecting a payment at a future date. So when you're talking about credit, we can say that credit is based on 3 key principles, and the principles are what we call the principle of trust, the principle of belief and faith, that when I give the goods to the customers, when it is time for payment, they will pay the debts that is due. So when we are giving credit, we normally talk about credit carries 2 types of risks. And the risk number 1, it's what we call the risk of payment at a later date than when you expected, or payment not being made at all. So you expected the money to come, but payment does not come on that date. So those two types of risks come with the extending of goods and services on credit. And maybe a question that we can ask ourselves today is, why do businesses give credit? Why do you have to give credit to your customers? As a businessman, why are you giving, or why are you extending goods and services on credit? There are a number of reasons as to why businesses or organizations offer goods and services on credit. Number 1 is, when you give customers credit, you encourage the clients to spend more, so which results to increased business. So if today you decide that I'm not going to give credit, I'll sell on cash, there is a risk of you not selling, because even the people who are buying from you, they are also being paid at a later date. So there is no time the cash I'm receiving and the needs are coincide. So payment will always come at a later date. So by giving customers or allowing customers to enjoy credit from your services, then what it means, you're going to get more sales, because the customers will access the products even before they can have the money. Then the other one is what we call, it increases the client goodwill. So the goodwill will be, they will be loyal to you. When you give goods and services to customers, they tend to be loyal to your business. They tend to come to you often, other than looking for another supplier, because where you are, you can give them the credit facility that they need. Then the other one is that it makes customers less sensitive to price and more focused on the services you offer. So customers will not really look at the price that you are charging the goods. They will be thinking of the benefit of them accessing the goods on credit. So you can even increase the profit margin, and the customers will not even query about the price that you're offering. They will not even ask for a discount. Why? It is because they are already enjoying the credit. So when I'm buying something on credit, especially for ladies, I usually talk about it passionately, because I know when we have people who have mastered the art of credit and they go to organizations, they sell items like clothes, like handbags, and because you're not paying now, you'll realize that more people will take the item and pay maybe end month, or even pay into also installments. So this enables customers to buy more from you. Then the other one is the reason as to why some businesses offer credit. It is for the purpose of billing the actual consumption. For example, our utility companies, they cannot afford to give, they cannot afford to charge maybe cash for water services, for example. You'll have to consume for them to come and check your actual consumption for them to bill. So some businesses also, it requires that they give you credit so that they can be able to come out to be able to estimate or to give an actual billing that you have utilized. So there are many reasons, and of course when we talk about giving credit, of course more sales, more profits, so that comes hand in hand. But remember, credit carries two types of risks, and we have talked about the risk of late payment and the risk of not being paid at all. So what is this that we are calling credit management? What is it all about? So in credit management, we are talking about the entire process of granting credit and even collecting payment. So credit management is the entire process. It is a process because you will recruit a customer. So we need to do what we call qualifying a customer or assessing the customer before you extend credit. 2, there is the actual aspect of now extending the credit or lending. If I'm talking from a banker's point, I'll talk about lending. Then there is the aspect of collection, now collecting the money on the due date. And then there is the issue of recovery. As we have mentioned, credit comes with the two types of risks. The risk of not being paid at all, the risk of late payment. So if you're not going to be paid on the due date, then you are going to do what we call recovery. You will now start pursuing, or you will engage a debt collector to go and pursue the customer for credit. So when we are talking now about the credit control, I think we need to look at a few components or aspects, or what we call the receivables management, the key areas of receivable management. And this one, we talk about policy formulation. We must have a policy in place when we are giving credit. Not everybody or not all customers should just access credit anyhow. Otherwise, you will attract all types of customers. So it is very important and very necessary that you choose you have a policy in place, or the guidelines or the procedures in place that will guide you in giving the goods and services on credit. 2, we will have to carry out what we call credit analysis, or what we are calling assessment. Not everybody qualifies for credit, so you have to have a way of assessing who qualifies and how do they qualify, and if they have qualified, what are the components that you're going to ensure they're in place. So you have to carry out what we call the KYC, or know your customer, so that you can establish if the customer has the ability to pay, or he has the ability to meet the obligation when it falls due. So you have to do what we call the KYC. And when we are talking about KYC, we will not fail to talk about the 5 C's of credit. When we are analyzing for credit, we talk about the 5 C's of credit, which we normally say we look at what we call the character of the person who is borrowing. We will also be looking at the capacity. Do they have the ability to pay? And do we have what we call, does he have capital? Capital in terms of, am I risking only my money, or he has also put something in the business? Is it a business that has a base, a capital base? Is it a business that is running? So that is a third C. The fourth C is what we call collateral. What will be my fallback? Because we have seen we carry the risk of being paid late or not being paid at all. Do I have a fallback? If this customer does not pay me, do I have a fallback? And then the other one is what we call the conditions. What are the market conditions? What are the conditions around? So you have to consider what is the market like? What are others offering? Are they offering the similar terms, or do I need to adjust so that I can fit to the market? So what are the conditions prevailing? For example, maybe the market is volatile. Maybe the market is shaken. There is no money, and therefore you need to consider before you extend goods and services on credit to a customer. Then the other one is the issues of now credit control. This is the housekeeping, which involves ensuring customers are paying you on time. These are the administrative roles, whereby have you billed, have you invoiced, have you sent the statements on time, so have you reconciled your accounts receivables, so that the statements that you send to the customer are right, they're correct. So those are some of the things that you need to have. The other one is the collection of amounts due, the aspect of collection. Many organizations, many businesses, they feel like asking for money from customers is you're bothering the customers. So you rarely ask customers to pay you. So you are waiting for them to pay. I want to tell you today that if you don't ask for your money, others are asking for their money. And those who ask, they receive. So I emphasize that in every organization, whatever size your business is, as long as it is offering the goods and services on credit, it is very important that you do the role of collection, that you carry out collection activities. And when you do collection activities, it will involve, of course, calling the customers, contacting them, writing emails to them, maybe even sending an SMS just to remind the customer that their account is due for payment. And of course, we are also saying sending reminders. And if the worst come to the worst, maybe we will need to do what we call we will need what you need to do, we will need to have a person who is charged of collection. Or if the business is small, I urge that we also take a time as a businessman or as an entrepreneur to contact and call the customers for collection. So with that in place, having the policies in place, carrying out what we call credit analysis, and doing the credit control management, what we call the housekeeping, then that would be good. Otherwise, thank you so much for the lesson.